Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about a variety of questions we've been asked on our community and in other places. Matt, do you want to share your screen and get us started?
Sure, it's high time we did this, Tyler. We get questions coming in on our online chat. Go to orats.com and chat there. And we have a community tab on our dashboard where people ask questions. We'll look at that later. And we have auto on our site as well. So we get a lot of questions, and we decided that it's high time that we kind of put them all in one webinar here. So I'd like to start with some questions that we get related to our Outlook page. So the Outlook page is on our analysis tool. And what we do there is we want to dive deeper into implied volatility and skew and such. So one of the things that we get asked is, what does the _C mean? We've talked about it a few times, but I just want to put it here. _C means is the ORATS lingo for the component weighted average. So what we're seeing here is Apple's implied volatility versus the XLK, which is the Spider S&P 500 technology ETF component. So it's got Apple and Microsoft and a lot of other technology companies. And we average all of those IVs and hundreds of different things. It's a really powerful tool. So this just go ahead, Tyler.
The XLK, that's our XLK is a real symbol, but XLK _C is our own symbol.
Correct.
If we're averaging the IVs and stuff, how is that different from just taking the IV of XLK?
Well, XLK is going to be different. So XLK is just the conglomeration of all those. So the implied volatility will be lower in XLK because of the power of diversification. Even though all of the other components under XLK will have higher volatilities than the average of those. So it's just a matter of, it's kind of a covariance calculation that you might want to look up separately, but that's why.
Got it. So the _C symbol sort of removes that as an issue. So you can sort of analyze it a little bit more statistically rigorously, I guess you would say.
Well, yeah, it's a really interesting other type of calculation. We have some Apple divided by XLK in our core data endpoints, and you can get at those in the trade builder. But this one is like I said, the Outlook is kind of a specialty deeper dive. And what we're seeing is, Apple divided by the components. So Apple's usually less because, Apple's a big company, but lately it's been going up. You would think one is the average of all the XLKs, right? Because Apple divided by the average of the XLKs, if it's one, that means it's right at the average. But it's usually at like 70. But like Apple's been a lot more volatile because it's mostly the tariffs and such lately. So it's been interesting. So we kind of say that Apple's implied volatility is high relative to its normal relationship to the XLK components. So does that make sense, Tyler?
Yep.
Cool. So let's go on to term structure and contango. Contango is one of those fancy terms that traders use, but all it means is that how low is the front month versus the back month. Okay, so and we measure that. So when it's usually the front month is usually lower than the back month, and that's a sign of calm markets. But when you can see it behind here, Apple fell out of bed and contango really went low. So it went into what was called backwardation, and that means the front month went high, which you would expect because it's really volatile, and they don't expect it to be volatile for a long time. So do you understand that about contango, Tyler?
Yeah, it is a fancy term people throw around, and in futures a lot too. But in options, it's just sort of meaning if it's up or down, lower than one, greater than one.
Yeah. So if the front is lower than the back, and we can see it's really kind of like bumpy here. So this is the actual term structure, meaning all these points are expirations in Apple.
You can
So, but
almost guess when the earnings is, huh?
yeah, it's right here.
Yeah.
But you can also click on X earnings and it really smooths it out. I mean, that's incredible, right? So this is what it actually looks like if you take out the earnings effect. And so that's one of the questions we get too. What do you mean by taking out the earnings effect? Well, each month that has an earnings like before it, earnings, it moves a lot. So the volatility is higher. So I'm going to take, this is just the raw number. So like September is 29 here. But if we take out X earnings, September is 27. So there's 2 points of earnings volatility in there that traders want to have and will pay extra because Apple moves and other stocks move a lot during earnings. So that's what X earnings means. And we look at the term structure X earnings. So we want to know, just how that's a way to normalize it. If we just look at it with earnings in, then contango would be all over the place and it wouldn't be, as good of a predictor of duress in the market. But now ORATS has a fancy way of taking, of figuring out what earnings is, and we make this smooth skew, and that's a way to show a rational skew. That way we know this is a good estimation for what we think the implied move is in Apple at earnings.
Yeah, normalizing the IV term structure for all of our symbols is one of the most critical things we do. And it allows us to compare a symbol to its history more rigorously, and then it allows us to compare it to other symbols, and then also to the forecasts. So this sort of normalization that we do paves the way for really good back testing and really good optimization and forecasting, which allows you to develop better strategies.
Yeah, really good point. I mean, that's why our data is clean. I mean, that's one of the way we quote unquote clean it, to get it consistent and comparable historically and to other symbols. Speaking of that, another thing that we do to compare to other symbols is a slope number. So slope is just this kind of like tangent at the 50 delta. And this is this is one of the expirations that Apple has. And we come up with it and we say, well, what's the percent difference between the 50 delta and the 60 delta? So every 10 delta is what percent difference is the lower strike going to be higher? That's how we talk about it. So it's usually around 2 or 3% here. You can see it hanging around 2. Right now it's very low. So that means Apple is very flat. So the slope is very flat. And one of the important things that we do is we look at it in terms of delta. So if you use delta, then that's one way you could really compare it historically, and you could compare it to other symbols as well. So that's another way to normalize the kind of put-call slope and normalize it and compare it historically and between different symbols.
Yeah, that's great, Matt. Yeah, so if that's that's the Outlook tab. If we're done with that, we got a lot of questions to answer. So let's move on to some other stuff.
Yeah. So the other big questions that we get are around the theoretical values that we calculate. So what those are we call it the D percentage, the F percentage, and the S percentage. So people obviously don't know that right away, but let's go ahead and explain that. And it's best just to explain it, with a simple call. So I'll add a strategy, just a long call, and take that out. And so, so here's, we rank these based on the D percentage. So what's the highest D percentage here? So still negative. So I'll show you what that means. So a D percentage is an expected value based on the distribution A distribution is what we create by looking at past moves in the stock and putting those in buckets. So at one point, at one point, Apple moved, or SPY moved down, to this 537 from 600. So it moved down this kind of percentage here, and it's done that 1.2% of the time.
And that it does it in the number of days to expiration that this option has, right? Like
the buckets are variable, so it's 3 standard deviations up, 3 standard deviations down, and then we make like 21 buckets, and so those buckets are changed by how long the days to expiration, in this case 25. So you make a distribution based on the expected move in the stock based on the volatility where it is right now. It's very complex, but what people should recognize is, like, if you look at it, this is not a normal distribution. This is a typical stock distribution where most of the time the stocks are going up. So you can see that, like, on the right side of the at the money, it's higher volatilities, but there's a bigger tail to the downside. There's not a very big tail up here. It's 0%. This is like 1.2. So this is saying sometimes it really falls fast, and that's the way stocks move. So we want to, the Black-Scholes assumes a normal distribution. So when we're valuing these calls, we want to look at it in a distribution that more matches what actually happens. And that's why distributions are a real interesting term and way that we look at valuations, Tyler.
Yeah, and that's a great explanation, Matt, and good bringing up the Black-Scholes there. A lot of our stuff is, we recognize the flaws of the Black-Scholes, and that's a good way to sort of bring a lot of the newcomers into ORATS to see what we value. And one thing to know, this is just one theoretical value, and we definitely encourage the traders on our platform to look at multiple theoretical values and not just use one singular value as like, oh, we had a really high distribution percentage here, let's trade it, right? Like, right. It's one way to value the option. It's not the only way to value an option.
And I mean, there's more, with all the macro stuff going on right now, there is more volatility in the market. So you just have to, like, and this is what this is saying. Hey, listen, this is a higher vol right now. This is a higher value of this option, because under the distribution, we have it worth $7.60, and they're paying $8.39 for the mid price right now. So so that says undervalue, but obviously there's a lot more volatility in the market. We're not really assessing that we're not saying this is a distribution when there's a war starting. This is just a distribution over way back to 2007. Adjusted for the implied volatility, so very high implied volatility, we adjust what buckets we're putting the percentage in. But so that's the distribution. So I want to move on to forecast next.
Yeah.
So the forecast is what we do is we look at the historical volatility right now, and we say, okay, well, historical volatility. What is, let's say it's something like a 15, and we say, okay, well, we have a regression analysis that we've done historically, with historical volatility being one of the independent variables, and then we calculate a regression, and we do a forecast on the future of volatility. So that's one of the inputs. And then we do a long-term forecast. So we do like a 20-day and a 2-year, because we're forecasting the entire surface. So then we need to forecast slope. We talked about slope earlier. We need to talk about how the term structure fits between those 2 points, if there's an earnings or isn't one in SPY, and then also the curvature, how curvy the smile is. So with all that, we come up with a full surface, and then each point in the surface, we line up with the delta, so there's a 47.9 delta with 25 days out. So we look at where that is, and we say, well, the forecast then is somewhat below 15. We don't present it right here. We could look. We'll look in the chain in a moment to see what that volatility is, but that's how we come up with the forecast. And again, this is a pretty good sign where the forecast and the distribution are both kind of under 10%, 9 or 10%. So we're saying that the market is probably like increased 10% because of what's going on, in the macro environment right now that's bumping everything up. Does that make sense?
Yeah, a negative forecast and a negative distribution is not a good sign generally.
Well, it means that there's additional volatility in the market right now that you need to, because trading's all relative. Like, it's hard to trade absolute. You don't want to say, oh, it's high, sell it. Well, there's reasons for the volatility to be high right now, but it might be higher in other things that it shouldn't be, and that's maybe where some edge is. So
yeah, that's a good point.
One thing we do is kind of cool. Like we could look at, the options chain, and the options chain has a lot of the, so you said one of the most important things that we do. So this goes and highlights what the SMV is. So the smooth market value is this thing that we do. So we draw this orange line through all of the points. And that, I think, is the most important thing that we do, Tyler, is doing that well. We could find, and for SPY, it's pretty consistent, but like we have to line up the puts to be right on top of the calls, and we do that with residual yields, having good dividends. So that's how you line up the call and put implied volatilities, and that's why we say, when we present this, often we say, well, there's just one delta. You don't want to have a different calculation of delta for calls and puts. It has to add up to 100, and that's why we line up the calls and puts, because if you don't, you have a problem with your assumptions for interest rates or dividends. So those are lined up. Then we draw a smooth skew through it, and that orange line is our SMV. So that is within the market like 95% of the time. So you could tell like this is 778. The bid is 778. The ask is 782, and it's moving, and the SMV is 781. This is 836. This is actually outside the market by 1 cent. So, but it's usually right around where the market is. And then we come up with what the SMV is, and what the the forecast is way below that, as we talked about before. So the forecast is based on historical volatility and some other things. But again, there's a lot going on in the market right now, so the volatility is somewhat higher, 10% higher about now. So this is the chain is a neat place to see exactly like the detail of what the volatility is at each level, and the SMV, and that's how everything kind of manifests itself in this chain.
Yeah, the chain's a great place to see where the SMV sort of sits with the bid and ask.
Right, and then the trade builder is a real good thing to look at as well, because the trade builder will present where we think the volatility is, and it's not just the forecast. The trade builder uses other types of calculations in order to give a surface kind of, and we give colors to it and the like. But the trade builder shows like historical volatility is this magenta line, and implied volatility is this blue line, and then all these dots are that's the term structure going out, and these dots are the amount of option open interest. And then you could also change the volume if you wanted to see that. We could zoom in a bit, just see. You could see that a lot of the volumes in the front days, like that's the 0 DTE stuff going on. Look how much more volume is in the 0 DTEs than any other month. That's kind of crazy.
Yeah, the with the trade builder, we get asked a lot about what those colors mean. So just to clear up that, so there are 4 parameters that go into the heat map over there on the right. and that's short-term implied volatility, long-term implied volatility, short-term slope, and long-term slope. And we look at those 4 metrics, and we sort of decide where to put those colors on the graph based on that. So it's basically, you're just looking at strikes under or overvalued relative to other strikes and expirations based on the slope in IV.
Right. So so we get questions on that, and then we get questions on the maybe we should look at the backtester right now, since we're kind of getting to it. So we what's the difference between our normal backtester, the Backtest Finder, and the custom backtest, and the Legacy Backtester? So you want to dive into that now, Tyler?
Yeah, let's do it. Yeah.
All right. So ORATS has, and this is, we're going to release this real soon. We just did a recalculation and added more symbols and got it up to May 1st, and we got all these backtests. So we have 339 million pre-canned backtests. So you don't have to go in and type in all this stuff and then get, and see what the returns are. And we also have, for a few of our symbols, we have entry and exit triggers pre-canned. So you can find out when is the best time to do an iron condor, or when is the best time to do a long put spread, or when is the best time to do all these other types of calculations. So, when the VIX is moderate, and then you could say, well, what does that mean? Well, the VIX moderate is between 15 and 20. The SMA is above, so, and we say what it is right now. So the RSI is overbought right now. The implied volatility of the 1 year is moderate, and the slope is high. So that's where that's where the SPY, whatever symbol you have right now, is, and those are the current environment. So we wanted to backtest, like, well, how does this iron condor work in various situations? So this is a really cool way to look at that. And then we also use basic exit. Are we going to do a stop loss, or are we going to do a profit target to get out, and what are the best ones? So you could look through hundreds of thousands for each type of strategy and pick out what you're looking for here, Tyler.
Yeah, the Backtest Finder, it's great. We're releasing all the new backtests. We're going to go up to 339 million. That's crazy.
Yeah. So that's the Backtest Finder. So remember that as, all these backtests are pre-run for you. But you could also go to the custom backtest, and this is a fast way on these same stocks to go run, basic strategy. So that's what, you could, again, all these stocks, do a strategy and do a backtest, and then you have kind of a little bit more customization. So if you really want to get customized, then you go to the Legacy Backtester, and this is what we've been hosting for well over 10 years now, and it has it's not built on the latest technology, but it has a lot of bells and whistles in it, and people are used to it. So if you have a little bit more patience, and you could look at some. I know that you're a UI designer, Tyler, and you don't like all the looks of it, but there's a lot of great things in here, and you could really create a backtest that has where you could set all the parameters. You could set the leg relationships. You could set when you're going to exit exactly. You could set if you want to look at it from a margin standpoint. So that this is kind of like the Ferrari it has a lot of adjustments to it, but it takes a little bit longer. Whereas the backtester, custom backtester, is again easier to run, but doesn't have as much complexity and nuance and inputs to it. And then the backtests are what we run, and with the inputs that are kind of our defaults. But you could like narrow it down, like say it like I only want days to expiration under 50 days. So it'll go find those, and it's really fast now. And the strike delta of leg 1, leg 2, 3, 4, you could set each what your strikes are. So you could narrow down all the possibilities this way and see the kind of, like in this case, long put spread that you want to trade. And so that's the difference. That's, one of the big questions that we get, Tyler, is, what's the difference between the legacy backtester, a lot of detail, between the custom backtester, not as much detail, but you could customize some things, and the Backtest Finder is where we've pre-run everything and you could filter them down to see which ones that you want to use. So do we get any more questions? That's mostly the questions that we get on that.
Yeah, and thanks for showing that too. Sometimes people are confused how to get to the legacy versus how to get to the new custom backtester. And yeah, so yeah, let's see what other, we got 5 minutes.
Yeah, so I think we should talk about our data, because for the data clients, this is maybe biting off a little bit more than we could chew, but let's just talk about this real quick. So you're able to get live data. Live data for a retail person isn't as expensive as a live data for a professional, right?
Right.
And so for professionals, we've come up with a live derived data. So that allows professionals, for example, developers or people that are just scanning for basic information. It's not live derived, doesn't have like the bid and ask. It doesn't have the actual stock price. We use put call parity to find a pretty good stock price. We use our theoretical values that we talked about before, the SMV, to come up with a theoretical value, and then you do all of your calculations based on that. So the derived is much less expensive from a OPRA and exchange point of view, but it doesn't give you the exact granularity of the bid-ask prices in the market right now.
Yeah.
So that's what that is. Delayed data is 15-minute delayed, and that's less expensive as well. Of course, our historical data goes back to 2007. The intraday historical goes back to 2020. And then there's delayed intraday and live derived intraday that you could go get minute by minute data as well. So that's kind of a quick overview, Tyler, of the data products that we have. And we know that it's a little bit complex, but that is kind of an offshoot of what the regulators say that we could sell and how much to charge, and we want to give as much to our customers as we can with the best prices that we can, to match what they need.
Yeah, absolutely. And we're we definitely listen to our data clients, and one thing we're releasing this week is the snapshot API. So if you're a data client and you want to get all the symbols in one call, you're going to be able to do that, and we're going to add those docs to the site this week. So
right.
We definitely hear your feedback on that, and we've also heard stuff about time and sales APIs, right? And maybe that can be in the works too. So we like to develop what our clients tell us, right? So we love to hear your guys' feedback on the data, and we want to know what's more stuff you guys want that we can deliver.
Yeah, that's a good point. So if you have questions, I mentioned the 3 main points. Like, of course, our community is quite active, and people are asking about net lick and the difference between stock price and spot price and grouping of positions. And so we answer all these, and the community answers these. So that's a good place. If you go to orats.com and you look at auto, you could ask a bunch of questions on auto right there, or you could ask questions in our chat here. We get back to you there. So those are 3 really good places. Or support at ORATS. You could email us, but we're sending more people to the community. So we're a robo RIA. So ORATS is a registered investment advisor, and the stipulations for a robo RIA is you have to have a website in order for people to go to and have tools, and that's where everything kind of, you don't want to favor any clients over other ones. Is kind of what a robo RIA tries to get at. So we want to put everyone at the website, at the dashboard, and answer all the questions there, so no one has any advantage over any other one.
Yeah, exactly. Lots of places to contact us. I just realized, Matt, you were talking about the historical intraday data. We're coming up on 5 years of that.
Yeah.
August 2020 was when we started gathering it, and now almost 5 years later, all that data.
And we own 2-minute data back to 2015 that we're going to start processing. So that we'll be able to offer minute by minute data all the way back to 2015, probably in a few months. So that's a crazy amount of data.
It is. Yeah. All right. Cool. Well, we're just about out of time. I'm sure there's more questions that we've yet to answer, but maybe some more of those next week. So thanks, Matt, for answering all those questions and directing people where to ask them if they have any more. You guys can also leave comments on the video, and like Matt said earlier, email support@ORATS or go to any of our other ways of reaching out to us. Thank you, Trader, for hosting us. We'll be back again next Tuesday at the same time, and I'll see you guys next week.
Thanks, Tyler.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.